Do you have an interest in knowing what's going to happen with the stock market? Maybe you have your 401k, your IRA, your retirement pinned on the outcome of the stock market over the next few months, the next few years. If you stay and watch this video for just the next few minutes, you're going to be able to reach your own objective conclusions about what the stock market is about to do. The decision you make could save you thousands, tens of thousands of dollars. It may even make you tens, maybe hundreds of thousands of dollars and save you your retirement. First, I am Bagger Don at StockMarketCaddy.com. We do not make specific recommendations to buy or sell a thing. We are a mentoring site teaching folks how to trade the markets in and out for short-term gains, cash flow. We have no vested interest in seeing the market at 5,000 or 10,000 or at 1,000 or 2,000. It makes no difference. Now, let me explain to you what you're looking at, and I'm going to play a little movie for you so that you can see for yourself what is in store for the market. This red line depicts the interest rate. The interest rate based on, down here on this axis, 3-month short-term treasuries, 2 years, 5 years, 7 years, 10 years, 20, and 30. This is the interest rate at 0. This is 2.32. This is 4.65. This is nearly 7%. Now, as this movie rolls out, you're going to see the interest rate being reflected as the S&P. This line here is the S&P 500, and it is going to correspond to this red line. As this red line advances across the S&P from the year 2000 all the way to where it is today, you're going to see for yourself what interest rates were doing, and if you stay to the end, you will answer for yourself what is going to happen with the S&P 500, the biggest, deepest market in the world. All other markets will hinge in your retirement on the S&P 500. So let's get started. We push animate. This is the S&P 500 in the year 2000. And here are the interest rates. Now watch the interest rates kind of flatten out and nearly invert. I'm going to pause this. Do you notice that the short-term interest rates in the year 2000 were nearly 4.7, almost maybe 5%, and the long-term rates were much lower? Right here. Watch what happens to the stock market. The stock market begins to crater. This is the dot-com crash. As the market falls, the Federal Reserve and the powers to be, they begin to do what? Lower short-term interest rates. They are manually and artificially dropping the short-term interest rates, creating a higher yield curve, short-term interest rates for short-term and higher rates over the long term, trying to pump money into the economy so that it can be reflected into the markets. Let's continue. And you can see what happens. They forestall any further crashing, and the market now rallies. And this is over 2003, 2005, 2006. The interest rates are nice and low. Everyone is borrowing money. They are bidding their houses up. They are buying second properties. And yes, we're headed for the housing bubble. But watch what happens as we approach 2007, 2008, and certainly 2009. The short-term interest rates are doing what? They're rising. They're letting them come up. They're flattening out. They are, once again, damn near inverted. Watch. Now this is over years. Right here. Short-term rates here. Up over 5%. Long-term rates virtually lower, inverted. Money is becoming tight. Watch what happens to the S&P 500. This is the crash of '08. And now the market is crashing down. And the Federal Reserve is reacting to the crash. What do they do at the bottom? And where are interest rates? The market is crashing out. They lock interest rates down here at nearly zero. They do it artificially, and they have it nice and steep. So the banks can borrow money very, very cheaply and loan it out. And what happens? The market stops going down, and it's once again party time. Everyone starts buying houses again. They're buying everything. This is the quintessential QE1, QE2. Notice, do they look anchored? Yes. You see the interest rates like this. This is the gas pedal to the S&P 500. The Federal Reserve and the powers to be have their foot pressed on the gas pedal. Now everybody is joining the party. They're buying everything. Second homes, third homes, NFTs, Bitcoin, crypto, art, baseball cards, and it's off to the races. And away we go. This is 2012. We got 10 more years of this, folks. If you can stay with just a few minutes on this video, you're going to find out where we are. You're going to find out what you need to do, and soon. Now watch as the market has a little jog here. Yes, the rates may have increased a little bit, but once again, this is manufactured. This is financial engineering. This is by the Federal Reserve. They control the short-term interest rate. They don't control the long-term, although they try. And still keeping it anchored. Everybody, it's a New Year's Eve party in the S&P 500 year after year after year. So away we go. By the way, if you want to learn more about stockmarketcaddy.com, you're welcome to visit our site. I'm going to pause this really soon. You start to see the market start to wobble in 2018. Look at the interest rate. It's starting to rise. Is that a warning of that little wobble? Now this is 5, 10, 15% corrections in the market. What happened here? Watch. Right before that market dropped, what's going on with interest rates? They're rising here and flattening out. In fact, you're going to see them actually rise a little bit more. And then what happens? That is COVID. Now, did COVID cause this? Or did interest rates cause this? COVID provided the Federal Reserve and the powers to be to do what? To lock down interest rates again. We have to We had to slow the economy, so they lock them down again. And what happens? Off to the races we go. It's party time. And the market races higher. Now, watch what happens. The market pulls back. Remember late last year, we had a little pullback. Now, watch the interest rates. We're getting close. This is 2022. Look at the short-term interest rates. They're no longer pegged. But the market continues higher, Don. Yes, it does. But watch. Look at the short-term interest rates now. They're really rising. The market continues higher. Short-term interest rates are approaching nearly 5%. Long-term interest rates are way down here, inverted, not good for the banks. But Don, the market is still running higher. Yes, it is. Why is that? Well, folks, and now we're right to where we are today. Short-term rates are here, long-term rates are here, and the market is right here. Why has it done that? Because most people who are in the market have no idea why they're in the market, why it's been going up, and they certainly have no idea what is going to happen in the next few months, the next few years. Now you do. In our estimation, the S&P 500 over the next few months into 2024, 2025 could collapse as much as 50, 60, 70, 80%. When that market comes way, way down here, yes, the Federal Reserve will do what it normally does and will lower short-term interest rates. But as you've seen for the last 25 years and even before, but we're showing you the last 23, 24 years, they won't lower the short-term interest rates. They won't put the gas pedal to the floor until the market breaks. They are trying to break the back of the bubble. Good luck.